Okay, welcome to another YouTube video featuring yours truly. This is for uh, Tuesday, January 31st, 2023, when we had a early dismissal of class. We're going to go over exercises 2-16 and 2-17. I said I would do it and get it out to you, and then it occurred to me just as I was prepping for this that you already have it in the one of the earlier YouTube links I sent you. Probably that one that runs nearly 2 hours. All right, so on bottom of page 2-39, they say use the following information to answer exercises EF colon 2-16 and F colon 217. They give us the transactions for Lawrence Engineering for July. And then you turn the page and they say journalize the transactions, include an explanation with each journal entry. We're not going to do that because they're self-explanatory. Then they tell us what accounts to use, which I went through, and they gave them in order. So I put them on one of these papers. You have two left over, and they're in order according to assets, liabilities, equity, and I forgot dividends, service revenue, and utilities. No, I got dividends in there. Okay. And then 217, post them to the T accounts, the journal entries to the T accounts, and then do a trial balance. Or compute the balance for each account. They didn't say do a trial balance. All right. Well, we might do one anyway. So on July 2nd, and the paper I have doesn't have a column for the date or posting reference, but I can put it here. Lawrence Engineering Inc. received a $14,000 contribution from Brett Lawrence in exchange for common stock. So the asset cash is being increased with the debit of $14,000, and common stock and equity account is being increased with a credit of $14,000 to record the investment of $14,000 cash and the issuance of $14,000 of common stock. I hold that up there for a while, probably not long enough, but you can always stop the tape, I guess, and focus on it. 4th of July, they paid the utility expense of $370. So the expense called utilities expense, and I started writing the expense, so I have to scribble it out. And it says paid, so we can very safely assume, or we don't even assume, we know for a fact that they paid it. So cash went down with a credit of $370, and utilities expense gets increased with the debit of $370. That's paying the utility bill, is the explanation on that. The expense account, normal debit balance, so that gets increased with the debit of $370. We paid with cash, so cash is going down. It's an asset. Normal balance is a debit. So we're decreasing cash, so we credit cash. July 5th, purchase equipment on account, $1,600. So the asset equipment gets increased with the debit of $1,600. And accounts payable, the liability account, gets increased with the credit of $1,600. July 10th, perform services for a client on account, $2,900. Accounts are being impacted here. Which ones are involved in this transaction? Well, we're performing services, so it's going to be a revenue account. More than likely, what the ones they gave us would be service revenue is being increased with a credit of $2,900. And it's on account, so we're not getting cash, but we're getting the promise of the customer to pay us. So it's going to be a debit to the asset called accounts receivable. Asset accounts receivable goes up with a debit. Service revenue account goes up, gets increased with a credit. $2,900 each. July 12th. Borrowed $7,100 cash, signing a notes payable. So you borrow money, you get the money. So the asset cash gets increased $7,100. The liability notes payable gets increased with a credit of $7,100. Try. July 19th, cash dividends of $200 were paid to stockholders. So dividends gets increased with a debit of $200, and cash, an asset account, gets decreased, so we credit cash for $200. Purchased on the 21st of July. Purchased office supplies for $840 and paid cash. So we're getting an asset called office supplies. So it gets debited for $840. And we paid cash. So cash is going out. It's an asset being decreased. So we'll credit cash for $840. And finally, on the 27th of July, we pay the liability from July 5th. So we got to go up and look. July 5th, we got equipment. We bought it on account. Now we have to pay for it. So the liability accounts payable is being extinguished because we're paying it off. So it's a liability, normal debit balance, but we're paying it off. We're liquidating it. So it gets reduced by $1,600, and the asset cash gets reduced with a credit of $1,600. Okay, so that takes care of 2-16. Now we are going to do 2-17. Open the accounts. All that means is we put names on those T accounts if you have one of those papers. If not, just get a piece of paper and draw yourself 3, 6, 9, 10 T accounts. And now we're going to take the journal entries, taking this information and what I'm putting into the general ledger individual accounts. So on July 1st, cash was debited. I'm sorry, July 2nd. Cash gets a debit of $1,400. And common stock gets a credit of $1,400. The journal had a debit to cash, so it comes over to the ledger as a debit to cash. The general journal entry credited common stock for $14,000, so they gets posted as a credit to the account in the general ledger called common stock. I'll just put a check mark there. I was off by a line, so now I have 3 check marks where I should only have 2. And I scribble that other one out because I don't have any white out here with me. On 4th of July, we paid the utility expense. So the utility expense was a debit of $370 and a credit to cash of $370. Utilities expense, debit $370. Cash is credited $370. July 5th, we get the equipment. It's debited. It's an asset, so it's increasing. $1,600. And accounts payable, we got it on account, gets a credit of $1,600. The equipment gets a debit of $1,600. July 5th. July 5th, we recognize the obligation to pay for that at some point in the future by crediting accounts payable for $1,600. July 10th, we did some work for people, and they didn't pay us, but they promised to pay us. So the asset account called accounts receivable gets a $2,900 debit, and service revenue gets a $2,900 credit to increase the revenue account. Accounts receivable, $2,900 debit, service revenue, $2,900 credit. July 12th, we borrow the money by signing a note payable, so $7,100 gets debited to the cash account and $7,100 credit to the liability account, notes payable. We get the cash, we get the obligation to pay for it. On the 19th, we pay dividends, so the dividend account gets increased $200, and the cash account gets decreased $200. Dividends increased, cash decreased $200 respectively. On the 21st, we buy office supplies for cash, so the asset office supplies gets a debit of $840, and we paid for them, so cash gets a credit because it's being decreased by the office supplies of $840. And finally, we pay for the equipment that we got on July 5th. So accounts payable gets a debit because we're reducing it. We're making good on our promise to pay. We're satisfying that liability. And how do we do it? By giving them cash. So cash gets a credit. Okay, the accounts payable gets debited because we're paying it off. Cash gets credited because we're paying them with cash. All right. Also transfer the dates. We did that. Compute the July 31 balance for each account. I'm getting my handy dandy calculator. All I'm going to do is add up the debits and credits for each account. So we have $21,100 on debits for cash. Credits we have plus 1,600, 3,010. So let's see here. $18,090 is the balance of cash. So what I did, I added up the two debits and got $21,100. I write it real small underneath the line. Add up all the credits. I get $3,010. Write it real small under the line, and then I take the net amount. We have more in debits and credits, so the balance is going to be debit, and it's going to be the $21,100 minus the $3,010, or $18,090. Accounts receivable, there's only one entry, so that's the balance, the $2,900 still owed to us. Office supplies, same thing, $840 in office supplies. Equipment, one entry, same thing, $1,600 is the balance. Accounts payable equal. So we owed $1,600, we paid $1,600, so the balance is zero. We incurred a liability and we paid it off. The note payable, one entry, $7,100 balance. Common stock, I did a little bit different this way. I added it up, wrote it down again, and I double underlined it because that's the balance, $14,000. Dividends, $200, double underline it, double underscore, whatever you want to call it. That's the balance. Only one entry in the account, it's easy. And that's the same thing for the service revenue and the utility expense. Now, it didn't say to do it, but now I'm going to take these and I'm going to make a trial balance out of it just to give us some practice on that. So, Lawrence Engineering, I'm going to put a heading on it. Trial balance. We don't have any time frames, so it would be, let's say, January 31st, 2023 today. All I'm going to do is list the accounts in order that I find them in the general ledger, the way they were given to me. Accounts receivable, office supplies, equipment, accounts payable, notes payable, common stock, dividends, service revenue, and utilities expense. All I did was list them. Now I'm going to pick up the balances and I'm going to note whether the balances are debits or credits. Draw myself a line here so it'll be easier for you guys to see the difference. Get it up, debit, credit. And now I just go through the general ledger T accounts, picking up their balances, and paying attention to whether it's a debit or credit balance. The cash is $18,090, debit. $2,900 for the receivables, debit. Office supplies $840, debit balance. Equipment $1,600, debit balance. Accounts payable, it's a liability. Credit or zero balance. I'm sorry, they listed it and I didn't even have to list it. Note payable, $7,100 credit balance. Common stock, $14,000 credit balance. Dividends, $200 debit balance. And service revenue is a credit of $2,900. And utilities is $370 on the debit side. $2,900 plus $1,600 plus $70. Get total debits of $24,000. And let's see what I get on the credit side. 21,100 plus 2,900, 24,000. So I know that the debits and the credits equal. And there's the trial balance. They didn't ask for it, but hey, may as well do it. Otherwise, the tape would be less than 20 minutes. Now I got it 20 minutes and some seconds. Okay, there you have it.